Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term, risk, and in the short term, confidence and sentiment. This month, I would like to update you on our thinking for 2018 regarding our Strategic Investment Insights, or SIIs. As such, I would like, therefore, to cover the following subjects shown here. Throughout 2017, our SIIs were impacted by the two tectonic forces at work, and critically, who would win out? Was it the debt supercycle coming to an end, or the central bankers' policy of monetary malpractice of increasing their balance sheets despite being in the late stages of the economic, business, and credit cycles, leaving them little room to fight a potential recession? 9 years is a historically long period without a recession. The global markets until very recently continued to rise relentlessly in an increasingly exponential fashion. But things there are changing, Martha. The markets are beginning to show exhaustion. Maybe more realistically, they are beginning to accept and reflect the shift in our two tectonic forces. First, the central banks have formally signaled a shift in monetary policy from balance sheet expansion to reduction in the case of the Federal Reserve with its program of normalization, and the other banks such as ECB and the Bank of Japan specifically to a reduced rate of balance sheet expansion, but expansion nevertheless. This is a shift from quantitative easing, QE, to quantitative tightening, or QT. Whether they fully follow through is yet to be seen and is highly questionable, in my humble opinion. Secondly, leverage in the system has become so excessive, margin debt so high, and investor cash balances so small that signs are emerging of tightening in the credit markets. This may be more than simply late-stage reactions, but the beginnings of a much larger reset of the $230 trillion global debt market, which can no longer be supported by meager economic growth and aggressive political forecasts that simply never even come close to being met. I have posted a large number of charts on MATA SII reflecting the signals we have been consistently receiving, which confirm our late cycle analysis. What is important to understand is that the Federal Reserve has historically entered such a period locked and loaded for rate cuts of between 3 to 4% to reduce and shorten the slowdown or possible recession. The central banks are now working overtime to build the required buffer into their rates. If this slowdown turns out to be more pronounced, which we feel to be highly likely, they will need more ammunition, which will include any number of policy shifts, including even more unorthodox levels for a possible QE4 and NIRP. It stands for negative interest rate policies, which we've seen earlier in the year and previous year, primarily in Europe. One of the wild cards in this tug of war is Trumponomics, which we discussed during previous SII updates. The Trump administration has achieved little legislatively in their first year against their stated goals. However, tax reform has been more than sufficient to power markets breathtakingly higher. Clearly, as this chart shows, Trump's policy proposals have had the same effect as QE3 or the summation of QE1, 2, and Operation Twist, at least as far as the equity markets go. However, that is not the real story, and unfortunately something the media fails to report on, lest they offend their advertisers wanting euphoric investors. These factors, however, are reflected in our shifts for our 2018 SIIs. U.S. dollar weakness has been with us throughout Trump's first year. It wasn't simply Trump that contributed to this weakness, because it was showing before the primaries, because of the U.S. government's continuous inability and failure to address its debt problems. yet still adopting policies of spending well beyond even current debt levels. Moody's recently warned of a possible U.S. debt downgrade based on Trump's tax cuts, fully exposing them again to the angry retribution of the U.S. Treasury and regulators. Let me state up front, I'm a big supporter of tax cuts, but not when they fail to be accompanied by fiscal cuts. Even worse, these cuts are dependent on short-term borrowing to fund them, and highly unrealistic long-term growth estimates with which to justify them. In our currently highly charged and polarized political environment, it is difficult to read an unbiased assessment of Trump's new tax bill. However, after clawing through the details, we've concluded that 3 analysts have got the key elements correct. David Stockman, former OMB under President Ronald Reagan during the last major U.S. tax cuts 35 years ago, Dr. Lacey Hunt, former Philadelphia Federal Reserve member, and Michael Snyder, CIO at Hallenbrough Investment Advisors. I've interviewed all of these people more than once. Their assessment is that Trump's tax bill is based on 1. A flawed understanding of the current stimulus multiplier, 2. A flawed assessment of U.S. Treasury supply-demand financing, the supply-demand, and the cost of money, 3. A flawed understanding of the money multiplier, the old Econ 101 formula that MV equals PQ. It doesn't work in this case. 4. A flawed understanding of the output gap and what it means during the late stage expansion cycle. 5. A flawed understanding of the yield curve and bank reserves. And 6. A flawed understanding of the global euro-dollar system. The Trump administration, however, may in fact not be naive to any of these, but simply be populist in its motivation. The president does seem to give the impression of being a snake oil salesman at times, who is always selling. How many times I've heard him say this, trust me, it's going to be great. However, whatever the facts, it has hurt the dollar, as you will see, and maybe even worse. It has clearly disrupted the bond market. This is a very important chart that we don't normally talk about publicly. It is a chart of the weekly ratio of the S&P 500 to the 10-year U.S. Treasury yield, plotted and importantly on a log scale, so that it reflects percentages. It is important because of the significance of both the dollar and the 10-year bond to the global financial flows. There are a lot of messages in this chart, but the 2 of importance to our 2018 SIIs are: 1. We have a death cross of our 3 proprietary moving averages. Bond yield spikes and the S&P 500 experienced a sell-off at precisely the death cross. This is a sign of an intermediate to longer term trend. 2. We also have a clear head and shoulders pattern with an approaching neckline. We believe the ratio is headed lower as these signals warn of. This is why our bond credit and fiat currency SIIs have been moved up to a shorter term focus. We'll discuss this further in a moment. I want to digress slightly for a moment to point out the CNY-USD cross. This is the Chinese yuan denominated in US dollars. Both China and the US are in desperate need of attracting foreign direct investment. As such, their currency and rates are critically important. You will notice in the bottom left-hand corner that the rates in China and US are the highest of all the major trading nations. This is needed to attract capital, the US to fund its debt, and China to sustain its growth and employment rates. Relative currency values are central to sustaining this. There is a lot going on behind the scenes with high-stake games being played to gain competitive advantage. This is more than just currency wars, but it reflects a new era of credit, capital, and debt wars. It's a financial war. The 2018 markets will see the results of this, and that will be tenuous and fraught with danger and a potential major dislocation or dislocations. Davos showed us that clearly the Trump administration is gearing up for anticipated major trade conflicts in the administration's year 2 with most of its trading partners, China, EU through the TPP, and Canada, Mexico through the NAFTA agreements. These are the countries where the initial salvos have already been fired and the gauntlet thrown down. The trade conflicts are going to impact currencies and therefore rates in 2018. This is one of a number of 2018 themes we see as drivers to our 2018 SIIs. A second major driving theme is robotics and chronic global unemployment. Global deflationary pressures are still with us, though inflation pressures are picking up and as a consequence driving rates higher in the short term. What we need to remember, however, is that we have a massive global employment problem dead ahead, which will place further pressure on the pricing power for labor-intensive products and services. The World Bank believes the global economy must produce a net additional 600 million new jobs over the next decade. This is a staggering number, but required as emerging and frontier markets play an increasingly larger role in the global economy. Educational and skill levels, along with political instability, are becoming less and less an impediment to investment and labor arbitrage by the global corporations. McKinsey & Company have produced an exhaustive amount of work indicating that by 2030, we can expect to see robotics replace anywhere from 400 to 800 million jobs globally. The World Bank was unable to assess what that would be, but McKinsey have studied this extensively. Advancing robotics technology now combines traditional motion robots with the Internet's massive data knowledge, along with in-body artificial intelligence, or AI, and the critical important facial and object identification technologies now available. The impact within the retail sector alone is expected to be profound. We are talking a potential 1.4 billion jobs here on a global population of approximately 7.6 billion, or 18% of the world's total population being impacted. Obviously, as a percentage of the working population, which we can assume to be 1/3 of this, we are talking even greater numbers, which approach 56%. Few people in the world are not going to be impacted in some way. A third theme is the fact we are in the initial stages of the big reversal. I did a macro analytics video on this with Charles Hugh Smith, which is available at matasii.com. We outlined in detail the points shown here, which were central to a groundbreaking research report authored by the Bank of International Settlements, that is the BIS, in Basel, Switzerland, as a warning to the global central banks. Due to demographics, as well as other factors, there is little doubt that the global savings rate cannot sustain the required investment growth rate required to support the existing $230 trillion of debt. I've done numerous back-of-the-envelope proofs in previous videos to show you this, but they're on record as pointing this out. This will be a central driver towards ending the era of the debt supercycle, in my opinion. As a consequence of all these factors, we have shifted our SII focus for 2018 to better capitalize on them, so we're ready for them. Bond and credit market problems beginning in 2018, major currency realignments in 2018 through 2019, infrastructure spending coming into political vogue, U.S. retail deteriorating further while defense peaks. We see coming strong dollar during a global flight to safety, and slowing trade potentially crippling commodities and energies in the near term or through 2018. In the bond and credit markets, it's about preparing for the coming turn in the credit and business cycles, as well as the quantitative tightening policies of the central banks. We've been indicating in our MATA SII Ideas posts that we are expecting a 2018 peak in the U.S. Treasury 10-year of 2.85 to 3%. Our current prediction is 2.85%, which was actually exceeded briefly a week after our call was put out. It would suggest we may see more of a sideways movement in the U.S. Treasury through June, or a possible pullback before testing the higher level and a possible double top. Remembering from our S&P U.S. 10-year Treasury yield ratio chart earlier, if the head and shoulders pattern does unfold as shown on that chart, then the simple math suggests the low in the S&P 500 could be that which we experienced during the 2008 global financial crisis. It was 666 in the S&P for those who don't remember. And of course that's based on a a 10-year U.S. Treasury of 2.85 calculation. We expect U.S. dollar strength in 2018, not for economic reasons, not by a long shot, but more out of global economic concerns which will result in an increasing flight to perceived safety of the U.S. dollar. As a consequence, there will be major opportunities in various currency crosses involving the dollar, the yen, the euro, and the British pound. All the currencies of what I call and have referred to as a currency cartel who are aggressively debasing their currencies. We have been following this chart on the US dollar since 2016 when it started warning us of a coming dollar weakness. We've been waiting on the current bottom. It was signaling, and we now appear to be close. We'll know better as Q1 2018 unfolds whether the chart continues to effectively guide us. The retail auto sector. The cyclical trend and lease financing trap in the automotive industry suggests the cycle will continue downward in 2018. We are maintaining our focus on retail automotive. Infrastructure, SII. Infrastructure has moved up to a shorter-term SII focus for 2018. Both U.S. political parties support it, though with completely different philosophical approaches, which will no doubt lead to political contention and grandstanding for the 2008 midterm elections. However, the requirement to pump an additional $1 trillion or more into the U.S. economy in 2018 will likely overpower all the Washington wrangling and distractions. Retail, SII. There is more downside to the collapsing U.S. retail sector, certainly, especially in the chain restaurants. However, the last percentage gains in shorting this sector can be the most expensive, since often takeovers and merging and acquisitions normally begin as the stronger players begin gobbling up the weaker participants. We've been taking profits in this sector through Q4 2017, though there still remain some good opportunities on our watch list. Few charts look better or have had better performance in 2018 than the defense sector. Many of the major players have went parabolic. Like retail, we think the major low-hanging fruit gains have now been realized versus the now increasing downside corrective risk. The exception are those defense contractors supplying cyber warfare and surveillance products. This is a major emerging new defense subsector, as evidenced by the recent $1 billion Homeland Security cyber hacking contract. The FANGs and NOSH SII has been a great SII performer for us in 2018. However, their gains have been a mere image of the increase in the central bank's balance sheets. We have shown that correlation many times throughout 2017. With the reversal in the central bank's policies, these high flyers are now exposed to minimally some corrective and consolidation forces as liquidity is withdrawn from the markets. We have moved them to our intermediate term focus and see a bias towards the short emerging. We aren't there yet, though we've been taking gains on all FANGs where our gains are 20 or 25%. I hope you found this update of value, and we will continue to update our SIIs throughout the year on a quarterly or at least by mid-year, depending on what unfolds. But as I often do, I want to remind you to remember, no matter what happens, they will print the money to solve any and all problems until such times as no one will take the money or it is of no value. That day is still well in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2018 be an outstanding investment year for you and your family. And I thank you very much for listening.